Welcome to another episode of Taking Stock for the week ending the 27th of February 2026. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome aboard, Matt. How are you today?
I'm very well. It's the last day of reporting period, so celebrations ahead, but it's been a pretty good, robust reporting period by and large. So we're pretty happy with the underlying results.
Yeah, definitely. And even though it's the last day, there's going to be a backlog of results to go through. So we'll be very busy over the next couple of days. But before we begin, just a quick reminder, the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile and any past performance figures aren't a reliable indicator of future performance. And also, Stock Doctor is now part of the Prime Financial Group. So if you require assistance with other services like self-managed super funds, accounting, or diversifying your investments into property or alternatives, please reach out to one of our customer service teams. Well, Maddie, it's been another busy week of reporting season, and overall, it's shaping up as one of the strongest ones we've seen so far. Consensus expectations, especially for earnings for financial year 26, have been revised higher, and that's unusual for this time of the year. Earnings growth for the market is now anticipated to be over 10% for the year to June, largely driven by upgrades across banks and miners. But across the other sectors, it's been a mixed picture. Matt, where are you seeing the biggest contrast?
Yeah, look, I take your point here. Miners have obviously been buoyed by a very robust commodity price environment, but in
Mm,
retail, it's certainly been a bit of a mixed bag, hasn't it?
mm.
ARB Corp was sold down after reporting weaker than expected numbers for the first half. Sales fell 1% and profit dropped more than 17%, impacted by softer Australian aftermarket demand, a sharp fall in sales to car manufacturers, and currency headwinds. The slowdown in four-wheel drive vehicle sales, particularly Ranger and Everest, directly hit accessory demand, while exports to the US rose strongly. Domestic conditions do remain quite challenging.
Yeah, despite the challenging domestic conditions, Matt, this is in stark contrast to Super Retail Group, which outperformed expectations. Super Retail, they grew their sales 4.2% and delivered improving like-for-like growth across most of their brands. Remember, some of these brands are Super Cheap Auto and Rebel. They gained market share, even though margins were pressured by promotions.
And importantly, free cash flow was very strong, and the interim dividend of 32 cents per share was very well covered by cash and profits. Trading into the first 8 weeks of the second half has also accelerated, which is really pleasing. The stock's trading an attractive dividend yield of about 4.1%, fully franked.
And speaking about dividends, we're talking about another company here, even Wesfarmers, a high quality conglomerate with very strong management. They saw their share price fall following their result. What's the reason here?
Yeah, it's hard to say, Ken, because profit actually rose 9%, and that was ahead of the market's expectations. Bunnings was as solid as usual, and Kmart continues to compete aggressively on value. But perhaps it was that delays in their lithium ramp up weighed on sentiment, whilst growth across other divisions has been moderating slightly. The fully franked dividend yield of about 2.8% provides some support, but to justify this high earnings multiple, we'd like to see more earnings growth in the periods ahead.
The evaluations there certainly look more reasonable. But and let's now turn to water infrastructure business Vysarn. The business appears strategically well positioned, particularly with the Karayara water scheme, potentially allowing it to own and sell water. And that's a step up from only providing end-to-end services. So why did the market react so cautiously with this one, Matt?
Yeah, interestingly, headline numbers were pretty strong, revenue up 63% and underlying earnings up 71%. But once you do adjust for non-cash gains, underlying profits were below the market's expectations. And more importantly, operating cash flow did fall 36%, largely due to receivables timing and tax payments. When accounting profits do outpace cash generation, investors tend to question earnings quality, even though the long-term opportunities with this particular stock does look quite compelling.
Yeah, and on the topic of disappointments, one stock that repeatedly runs out of momentum every time they attempt to rally is online lotteries operator Jumbo Interactive. They delivered a decent set of numbers with guidance largely unchanged, but the market is still skeptical with this one.
They are. It's very frustrating because they've been a star stock for a very long period of time. We understand the business, we know the management team. The numbers are always been quite robust, but unfortunately, in this period, jackpot activity did remain really subdued. Powerball represents roughly half of the lottery retailing sales, and jackpot size is quite unpredictable from period to period. Also, the dividend was cut by 50%. We knew this due to all the acquisitions that they've been making, and it now represents 12 cents per share under their revised dividend policy payout.
Yeah, and even though it's been revised, this translates to a roughly 3% fully franked yield. The business does remain cash generative, but a meaningful turnaround likely requires either strong jackpot cycles or further international growth to help diversify its earnings. The ex-dividend date is on the 3rd of March with this one. And turning our attention to Woolworths, typically viewed as a boring defensive, the share price did surge 13% on the day of its results, even as the ACCC, there's scrutiny of their supermarket promotional practices. That's continuing. So what's shifted the drive in such a strong share price reaction here?
Well, look, we were pretty pleased with 13% on Woolworths. I don't think I've ever seen Woolworths move that far or that high in one day. But look, I think what was the share price had been under pressure leading into this result. So markets were quite pleased that sales momentum was starting to look like it's really building. Australia's supermarkets sales grew 3.6% for the first half and 5.8% in the first 7 weeks of the third quarter. Earnings rose 14% and management has reinvested in price. It's introduced 300 lower priced items and cut about 200 million in costs, which is somewhat of a thematic that we've been observing over a reporting period. What we have seen in terms of cost cutting and reducing headcount, WiseTech, for example, and this morning, Block have announced huge headcount reductions and embracing AI agents to replace them. So this is certainly a developing thematic, and we're looking very closely at how this sort of plays out over the rest of the year.
Yeah, definitely. And what about WiseTech as well, Matt? You mentioned that. But AI disruption is certainly coming hard and fast, and companies that are too slow to react or don't know how to innovate will be left behind. But there's been many other results announced this reporting season. So please stay up to date with our Star Stock changes in the recent update section on Stock Doctor. For under the microscope this week, let's look at mining giant Rio Tinto. It's moved back into our Star Growth stock portfolio, but also has been initiated as a Star Income stock. The dividend yield is around 4%, with the stock due to go ex-dividend on the 5th of March. Now, many investors might ask, how can a miner undertaking significant capital expenditure qualify as an income stock?
Well, Kien, I think the answer lies in cash flow strength and balance sheet discipline. Free cash flow is expected to ramp up significantly this year to support a step up in its dividends. Meanwhile, its debt level relative to earnings is very conservative.
Yeah, I noticed that full year dividends were maintained at around $4 US per share, and that's on a 60% payout ratio at the top of their policy. Now, this is slightly different on Stock Doctor due to the Australian dollar translation, but that said, given the cyclical nature of commodity prices, it may not be suitable for highly defensive income investors.
And interestingly, the company failed in its attempted merger with one of the world's largest diversified miner, Glencore. What was the rationale behind that deal, and what's the strategy now, Ken?
Well, the rationale was scale and copper diversification, Matt. Copper is central to electrification and energy transition themes, but management did walk away, and they walked away due to valuation discipline. And under the new CEO, Simon Trott's stronger, sharper, and simpler strategy, the focus now shifts to organic growth, cost control, and also extracting value from existing tier one assets rather than just those transformational M&A opportunities.
And iron ore still does account for around 56% of the underlying earnings, with copper about 25%. That contrasts with BHP, where copper now exceeds iron ore. But looking ahead, copper volumes are expected to grow roughly 11% in the financial year 26, as Oyu Tolgoi ramps up. Samandu and lithium also provides long-term diversification, with the return on invested capital forecast to exceed 23%.
Yeah, there's certainly some difficult names there to pronounce, Matt, but you did pretty well. But however, iron ore unit costs in the Pilbara, they are expected to rise, which is an active risk we're monitoring. But the stock has rallied strongly in recent months, but consensus does suggest Rio is trading around fair value.
That they are, Kien. And despite declining in recent months, short interest does remain quite elevated, likely reflecting concerns around cost inflation and iron ore sensitivity. So those who are overweight should consider trimming profits.
Over the reporting season, share price targets under Golden Rule 5, they change rapidly after a company releases their results. So an interesting question this week is, how should investors interpret the consensus price target under Golden Rule 5?
I think that firstly, we need to point out that it is oftentimes a useful guide for valuation, but it can be quite volatile and sentiment driven, as you've pointed out, Ken. So what it is the consensus price target is the median for 12-month valuations from its analysts, often using very complex models like discounted cash flow. So in the context of, say, a Rio Tinto, for example, they're based on assumptions about future earnings, about commodity prices, about margins, and they apply a discount rate to their DCFs. These assumptions can change frequently, which means that the analysts' valuations are also, by default, quite sensitive.
And what I've found quite throughout history is that price targets often follow the share price rather than lead it, as analysts are generally reluctant to appear disconnected from where markets are moving. As a result, buying a stock purely because it trades at a discount to consensus targets can be quite misleading.
I totally agree with that, Ken. So what we think is more powerful is to look at the direction of earnings revisions, which provides insight into the underlying fundamentals and ignores share price sentiment. Under Golden Rule 3, you can see that the three-month change in consensus earnings revisions, and this trend tells you more about earnings momentum and blocks out what we're talking about here, which is market sentiment.
And also look at the analyst coverage as well. Fewer analysts mean less reliability in those targets and earnings. And for high quality growth stocks, trading above consensus targets for extended periods is not unusual. It's best to try to understand why a stock is trading at that premium or discount, because sometimes you need to pay a premium for quality. So consensus targets are best used as a sentiment gauge rather than a crystal ball. But that wraps up another big week of reporting season. Thanks for your insights, Matt.
My pleasure, Ken.
And if you have any friends or family who you believe would benefit from Stock Doctor, please reach out to them. We innovate and grow because of our members, and we appreciate your ongoing support. Until next time, have a happy, healthy, and prosperous week ahead.